Hey guys and gals, Kevin Bupp here. I've got some very exciting news I'd like to share with you before we jump into today's show. Now, after closing on Fund 4's first acquisition of a $50 million institutional grade mobile home park, we're adding a second irreplaceable piece of real estate to the portfolio, and it's coming into the fund with over $1.5 million of built-in equity for our investors day one. Now, when I say irreplaceable, I really do mean it. I mean, this is an affordable yet high-end waterfront mobile home park located in the Columbus, Ohio market. Quite literally, every single mobile home on this property is right on the lake, each with its very own personal boat dock, meaning a very high demand for affordable weekend getaway options, as well as year-round housing for working Americans. This is a true unicorn of a property, and you will not see another one like this come around again. It really is a one of a kind. A few other aspects worth noting. This park is producing stable and predictable cash flow day one. We're acquiring it with an excellent in-place Freddie Mac loan at a 3.3% interest rate for the next 8.5 years. This also includes a period of interest-only payments. Again, the simple supply and demand dynamics here are enough to get excited about. This is affordable lakefront real estate for both the working American families as well as folks looking to lock down a reasonably priced waterfront escape. Don't let this opportunity pass you by. Visit investwithsunrise.com to register for our webinar and learn about all the wonderful aspects of this property going into Fund 4. Again, that's investwithsunrise.com. Now, let's get on to the show. Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cashflow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, our guest for this week's show is investment expert and best-selling author, Sal Buscemi. Now, Sal is a former investment banking professional from Goldman Sachs, a three-time published author, and now serving as the CEO of a multifamily office. Now, his portfolio prominently features private-held life sciences companies, complemented by a diverse array of high-performing enterprises and select industrial real estate assets. Now, in the real estate sector, his focus is consistently on Class A properties. He group partners with top-tier sponsors who have weathered multiple economic cycles, commit significant co-investment, and maintain audited financials. And so, guys, with that, it's an honor to welcome back Sal Buscemi. Sal, how you doing today, my friend?
Kevin, it's a pleasure and a privilege. That's quite the intro. I appreciate it.
Yeah, good deal, buddy. Well, now excited to have you back here. It's been a number of years. I know you've had a lot of great things happening in that span of time. But let's we'll back it up just a short bit. And for those, Sal, that aren't familiar with you, your story, again, that was such a brief introduction. There's a lot more to fill in the gaps. Yeah. Maybe take a few moments and tell us a little bit more about yourself.
It is, yeah. Well, I'll tell you that I currently reside in Florida right now, and I'm the co-founder and managing partner of Brahmin Partners. And we have not done a lot of real estate recently, but we're getting back into it right now. And the reason is because real estate was getting a little hot after the pandemic, and me coming out of Goldman Sachs, understanding how these markets work, I knew that there was going to be a lot of problems. In college, I went to college. I'm originally from New York. I went to college in New York, and I was a biology chemistry major. And I can tell you, Kevin, that towards the end of my junior year, I passed out holding a fibula in the cadaver room of Beth Israel North, which is, around on the Upper East Side of Manhattan. And I can tell you that at that point, I had to have a really strong come to Jesus meeting with myself and also the doctor I was interning with. And the punchline followed on and said, "That's okay. I've been telling my brother about your work ethic," because I just spent so much time, I wanted to network, but also give these guys the best work I could, sort of like academic work, right? Because he would be writing a recommendation to his alma mater, which was, I think, Johns Hopkins. Yeah, it was Johns Hopkins. And there was a lot there going, but he finally said to me, he's like, "Look, my brother just made partner at Goldman Sachs. He wants to talk to you." And that sort of started everything. And I've always had sort of like a fascination with finance and things, and even with the boring savings bond, the Series HH, and my father during the 70s putting my brother and I through college with zero coupon bonds, and we'd come in and cut with the scissors and send the coupon out, and then the money would come back. I was like in the old Prudential beige manila envelope days, with the we'd go to the bank in the safe deposit box. So it's been really a very interesting career, I have to say. We just had, in the non-real estate stuff, and I know you're a real estate guy, but we'll get into that. But in the non-real estate stuff, we've had some exits recently. We, not only we were involved in things like such as Airbnb and Lyft, but also one of the deals that you probably haven't heard of, but it was Sumitomo Life that bought one of our target companies that we participated with a very prominent family overseas with in Hong Kong into Sing Life. And Sing Life we just got the cash distributions and we're still sending out the cash distributions as a go. And I spent a lot of time on the banks, making sure that I'm not going through the fraudulent, making sure, like, are you sure you want to send this to the right recipient? So we spent a lot of time, in the unglorious part of life, making sure that, we can accommodate that. But we have a very large family of investors that follow us, but also we have about 13 families that we work on behalf of. And we've been able to amass a very good portfolio by just going what I like to say, mile deep, but an inch wide. And, when we look at these opportunities, we're not looking to be like maybe like a broker dealer or a realtor. We're like, you don't like what's in my left pocket? Well, Kevin, you're going to love what's in my right pocket, right? So we're very targeted and direct. Some of the deals we're working on right now is we're finishing our last slug into SpaceX. I think that's finished. We have Neuralink that we're going into, but also in the life sciences stage, we have a company called Thrive Bioscience, which it will be the founder's 18th exit and 8th unicorn. And that is, set out to replace the microscope and a lot of the conventions of gathering data that has been antiquated using the petri dish and changing environments and everything. So it's very, very interesting, to be involved in this. And the people you meet is just a really, really great business, and it's a people business. And most of all, it's a relationship business. And
Yeah.
I don't know if you've got my emails or if you want to get on it, but we depend on interactivity. I send emails out all the time. There's one going out with pictures that I sent you from the last conference we went to. People really like that, and that's really, I think, for those of you who are starting or even established, it's never a spreadsheet. Today you can do a spreadsheet and ChatGPT or Python, and they can give you whatever you need. It's all about the relationships, and I think that's going to be the most coveted skill going forward. If you're in the capital raising business, because what's the second rule of real estate, Kevin?
Never lose money. It's first and second rule to me, but what's your second rule?
There's a lot of people who didn't pay attention to that rule and they're losing money. It's always to be raising capital.
Yeah,
and so,
fair point.
when you're on
Fair
top of
point.
that, you always want to be raising capital. Yeah.
That's my third rule, but no.
That's your third rule. Okay.
Well, let's talk about that a little bit. Let's talk about, you
Yeah.
made a comment as it relates to just your formal training with Goldman Sachs, just, really teaching you discipline during, I guess what were some overheated timeframes. 2020 pandemic kind of kicked it off and really ran through up until really the Fed started making big moves with the rates. And so, it's interesting because I felt like we were fair. I mean, we were very disciplined, almost. At certain points, it's kind of hard to play with that push and pull, right? You see everyone around you doing, making transactions, activity. I mean, it's abundant, and it's very difficult to kind of sit back, be disciplined with your underwriting, to say, hey, like it doesn't make sense. We can, as you can play around and goof around with the perform all you want, and make any deal make sense. But ultimately, we didn't buy a lot in the span of 2020 to 2023, and actually became more of a net seller than anything else. And we sold a lot of assets, took advantage of the opportunity, given where we couldn't make deals make sense that we've owned for many years based on what someone else was willing to pay. Hey, let's exit out and take advantage of the what we felt was the peak of the market. So would love from your perspective to get a better understanding of that disciplined nature that you guys practiced during that period of time. And then ultimately, 180 it to where we're at today, and why, you made the comment, you guys are starting to get back in. You're starting to see now, the forest through the trees with regards to real estate and some opportunities maybe coming down the pike.
Yeah, I think, when a lot of people, they got into this, you had the multifamily syndicators, you had like a lot of the residential based syndicators, and what they were doing is they'd never been through a cycle before in their life, right? Think about it. They were in high school during the last great financial crisis. They don't really remember anything. So, they're sort of coming of age right now where they see low interest rates. They believe low interest rates are an American right that's in the Constitution. And so they were outbidding each other. But whenever you see those opportunities happen, Kevin, where you have a lot of people that are outbidding each other, that's not really a good market to get really involved in. Warren Buffett's famous for saying it. I don't know if he pioneered the term or not, but be, greedy when other people are fearful. And, because of the relationships we have with some families internationally, we were able to participate in some opportunities that most might not be able to get into because they're reliant upon bank financing. And there's no bank financing today for a lot of this stuff. Even the government sponsored agencies, the GSEs, they partner with, GPs and people in residential because that's the business that they want to be into. However, you take a tremendous amount of risk doing that. The families we work with, they're already rich. They're not looking to get rich. So they're not looking for the wealth creation. They're looking to put something in a store. In many ways, as far as like a store of value, and that can come in different ways. Class A real estate, if you were to look at the Zara co-founder Armancio Ortega with his family office, he buys only Class A office and industrial and cold stores, just like us. You look at
Hmm.
some of the churches that are more endowed, and like the LDS Church or some of your Ivy League institutions, they're invested into illiquid things such as industrial logistics, cold storage. And the reason for that is because there's a different quality of tenant there. But getting back to your original question, is that what a lot of people don't understand is that and this word's thrown around all the time, and it's called diligence. But diligence means different things to different people, much
Hmm.
like love means different things to different people. And everybody thinks that it means one thing, but it doesn't. And a lot of people were doing the diligence on like rental inflows and everything like that. But what they never thought about is what happens if the capital markets turns its back on you? What
Hmm.
happens? And Trump, in his first book, The Art of the Deal, talked about this succinctly. He said when somebody tapped him on the shoulder when he was sort of like, before he went into his bankruptcy, that the capital markets can be very cold when it can be very cold breeze when the capital markets turn their shoulders to you. And that's something that, if you're if you've been in through several cycles of distress, you appreciate it, you understand it. But first and foremost, we're stewards of capital before anything else. We're not
Hmm.
looking to do anything as it relates to putting too much risk out there. Now, is there a risk in real estate? Absolutely. I mean, we were looking at a Class A office up until today when I canceled the deal because I think the basis was a little too high. Does that mean there's going to be other things coming? Sure, but we are very, very, very choosy about the deals that we get into at this point because we expect to have high quality tenants.
Yeah, speaking of that Class A office, that's interesting. I would love to just maybe touch on that a bit. And if anyone follows any of the data out there, the trends. I mean, the Class A is if there's anything that's doing remotely decent in the office markets, it's Class A, right? It's the
Yeah.
trophy assets. A lot of the B and C stuff. I mean, it's just functionally obsolete, and it's has incredibly high vacancy, and no one
It's
knows exactly what the
perishable.
future holds. I mean, no
It's
one knows what
perishable.
yeah.
Yeah.
So I guess what is maybe speak to the what you envision. Maybe this one deal, use this as a case study to give me some of your insights as to the opportunity that if given the right basis, what's the opportunity in the Class A
Well,
stuff over the long run?
you hit the nail on the head, and it's all about the basis. And this basis
Mhm.
clocked in a little high. It was selling for about, without getting into too many details, I
Yeah,
think it was
sure.
70% occupied. It already gone through a big capex, um, there were some players there who I didn't know about, who I didn't trust. Number one, like a co-investor, co-LP in this, and number two is the basis was just a little too high. But
Yeah.
you're buying something at a discounted value, to probably around 50% of its last trade, 270, I think, is around half of that. Still, that's not really enough. And this isn't a repurposing or anything, but
Yeah.
different capital has different needs and wants. And this would be perfect for an overseas investor with a lot of money to park it into something, to say that they own Class A real estate in
Hmm.
Manhattan. You have to also have a belief in Manhattan too. I also think that there's going to be, like it or not, I think of what's happening with the whole Trump thing right now, that sort of spooked a few investors. And I think that's going to change, as far as property rights and things. I mean, who would want to invest in New York right now? If you can have your property taken away from you for, whatever reason the judge feels that way. So a lot of other investors don't feel that way. They think, New York is still a great place. It's going to work out. And usually the cycles do. If you look at September 11th, New York did
Hmm.
cycle out. People who bought, office, and, they did very, very well after that point. So you got to think about politics sometimes being just as caustic to values as anything else. And that's something that a lot of people don't put into their underwriting. And that's
Yeah.
what ruined a lot of families actually in New York and some of these other cities where they had very pro tenant laws. They couldn't make payments. And so they wound up getting, a lot of their apartments foreclosed on. So, there's always a risk in real estate. It's never safe. It's never the building. Remember, it's still a people business. And if AI
Yep.
hasn't, if the internet hasn't digitized it yet and AI hasn't yet, what does that tell you about the asset class? It's still a store of wealth, but remember, these guys are
Sure.
not looking
Sure.
for Class C, in Scottsdale, Arizona. They're looking for something where it's like, this is a statement asset. This is, what you read about in the real deal, with these trades going by, like these huge office buildings or, developments being planned. That's where we like to play.
How about Chicago? What's your gut on Chicago? If it was a Class A trophy asset at the right
Uh,
basis in Chicago, where did local politics play into that decision?
I don't see a lot of people really moving into Chicago right now. It's just one of
Yeah.
those cities
Yeah.
that people don't have a lot of confidence in. I think people have a lot more confidence in New York because of, situations it's had probably over the past 50 years, right? So back in 1975, when I was born, it was, the New York City was bankrupt and a lot of families bought just for the tax rolls, apartment
Hmm.
buildings and everything that you could think of. And there was a lot of reasons behind that too. Robert Moses had something to do with that. A lot of the migration had moved out west or east to suburbia that was newly created after the war, and that took a drain on the city's finances. Then you had September 11th, and then you have the pandemic. So there has been resiliency, but also I think every time you have some sort of a catastrophic event like the past 3 years I've talked about, it's going to change the function of the asset, the function of the asset, whether it's perishable or not. I don't think New York City office is perishable. I think certain offices are, and I think there's a new theme out there, which is hospitality office or office hospitality. I'm not really buying into that. But everything right now is basis driven. And that wasn't basis driven
Yeah,
before because
right.
there was just so much capital available. Anybody with a pulse could get a bridge loan. And that's what the pandemic did, is that it made money so available for the lowest common denominator during that point to be able to get loans on multifamily, where people who didn't really understand the math behind it really, they're paying the price right now.
Yeah. So what are you most excited about today? I mean, what's top of your radar? You're spending the most time, putting your energy and efforts into.
It's interesting. I spent the pandemic building the multifamily office in a legal structure where
Hmm.
we could be deft. And I have a fund structure. I don't like using funds, in a venture thing. And the reason for that is because families today, funds are a four-letter word, but it also incentivizes the fund managers to make maybe imprudent decisions because they have all this money they're sitting on and they have an IRR clock to their head. So if you were to invest in my fund tomorrow, you'd say like, "Hey, Sal, did you deploy the money yet?" No. And that's not what you want to hear because you expect an immediate return on that. And I think a lot of people with funds have done that. So we use a single purpose vehicle. We have an elaborate structure that we put together with a top Chicago law firm, and they put it together in a way where mice go where elephants can't. So a lot of the successes we've had have been investing alongside other families into world-class companies, maybe not name brand like SpaceX, Neuralink, or Stripe. We did invest in those deals, but other ones too as well, that you might not have heard of that you will hear of. And some of them are AI. For example, AI.io, that's a sports recruiting program and app, which it will be used by the NFL, but it's already used by several major league soccer teams in Europe. And one of the co-investors in that is, I think, David Bowie,
Hmm.
not Bowie, David Bowie, but who's the guy that bought Chelsea from Abramovich? I can't remember his name.
Yeah,
Yeah, yeah, okay.
I know who you're talking
Well,
about, but yes, don't have
yeah,
the name.
yeah,
Not
yeah.
David
So I
Bowie.
mean, yeah. Not David Bowie. God bless his soul. Great musician, love him. But I think what we're looking into right now are those opportunities where you just have world-class GPs, world-class companies, privately held that we can invest into. That also will leave some sort of a legacy too. We got into health sciences,
Hmm.
life sciences. We've done very well with that. We're pivoting now more towards the AI and life sciences and technology, getting involved into these deals. But it's exciting. It's fun. Does it sound like there's going to be a lot of hysteria into it? Probably, but I remember the go-go 90s during the dot-com bubble. So, we know what to expect on, how to play both sides of it. That really gets me excited right now. And then also like some of the distress that we haven't seen in real estate yet, but we will see in real estate. I think over the next 6 to 12 months, you'll start to see things move right now. I don't think in real estate now's the time. I don't think it's really anything started yet. I think a lot of people are just paralyzed until after the election, and that's my
Hmm.
conjecture. And then you'll start to see some things trade. There's no, there's nobody has any insight into interest rates, and that's always going to be a driver of values in real estate. And again, I know that I'm on a real estate investing podcast, and there's no sort of outlook to that. I think if you were to look at Jerome Powell, cutting rates are optional, not necessary. And I think,
Yep.
that's something we need to think about going forward. And, I'll just tell your listeners out there, you got to be very careful who you take information from, because a lot of the people who come from these name brand firms, they have a paycheck. And if they don't speak the party line of, oh, rates have to get cut in order to get the clicks or something like that, they're not going to have a job. So you have to be
Yep.
cynical at best and paranoid at worst. And, really talk to people who have money in there, who the playmakers are, who are really taking advantage of all that. Does that make sense?
Yeah, no, absolutely. I mean, so to that point, I guess looking at this from more of a SWOT analysis perspective, speaking to threats, I mean, and speaking to your business more particularly
Mhm.
about what you guys do day in, day out. I mean, where do you see that? Where do the threats lie? Again, there's a lot of uncertainty, still not, not full clarity, especially in capital markets. But I mean, speaking to what you do, threats, what are they
Any
and how do you get
anything can
around them?
Yeah, I mean, anything can shock the system right now, but if you really want to go down the rabbit hole, don't ask me about sports or anything like that. I don't know anything about sports. But I think if you really want to go down to the rabbit hole, the threats are right now is there are, as far as housing, you're starting to see a societal change, and I don't think it's really good. But I'm a finance geek, pure breed finance geek, and you're starting to see like schools in Dallas, for example, ISDs, these great schools, they're starting to close because people can't afford homes right now. It's becoming kind of an issue. It's problematic, and if you don't have the people who can afford the homes, then that is going to directly result in school attendance and things of such. If you were to look at other things as it relates to some other things as it relates to geopolitical, I think that we're fighting a lot of things we don't understand. But there's one thing that really bothers me that nobody really talks about. And if Iran closes the Strait of Hormuz, you're going to see the price of oil from where it's like 90 right now to where Biden's trying to artificially keep it low, before the election. It could shoot up to maybe $200 or higher a barrel. And that is going to cause a toxic shock to the economy because no country has ever survived without having a thriving middle class. And this country, Kevin, was not built on or for $15 a gallon gas. You have to think about it. And
Yeah.
there's some things on Facebook I follow along, and it's like, hints of yesterday, and it was like, oh, here's an advertisement for a 1971 Ford, which was larger than the last boat I had. And to me, that was peak America, right? And so, at that point, like you could have a car that big and you could have multiple cars that big because we had, the dollar was king. It still will be king. I think there are some threats. I don't think people are going to start transacting in crypto. I think you have 75 trillion going around the world each day in Swift's wires, right? Things, trading hands, cash trading hands all the time. I don't think that's going to change to something else, but I also think that there's a lot more that we could be doing right now to sort of shore up a lot of the things that are happening, not just domestically, but internationally.
You speak to crypto. Do you have any involvement there? I mean, have you dabbled in that side of the house?
We haven't. I don't, to us, it's not something that our investors want to get into. Remember,
Hmm.
crypto is a wealth creation device for the most part.
Fair
I
enough.
was here in Miami 3 years ago, and I can tell you that we were invited to a party, and I found out later that the bill was like $35,000 at the Fountain Blue at Art Basel. And I said, "This is the end of it. This is the end. This is peak crypto. This is not their money. These guys have no idea where it came from or how it was made." But I think that, when we look at the blockchain, there's a lot of use with that, just like there's a
Yeah.
lot of use with AI that's coming out and generative AI. But I don't see crypto being something we're going to go headfirst into. It's not really something that you want to lead. However, there is a very established manager that we know that we might be investing into, which has like a crypto long short fund that we're looking at,
Hmm.
only because it has certain structures in it where, he's achieved high returns. And my partner is more acute to this than I am. But it also, I think it pays out too as well on quarterly. So that's something that, just somebody wants some exposure to it. We might get into it, but we're not going to be going head first to it. I think crypto needs to come into it. It's like, I think there needs to be, and this is my conjecture. It's a wealth creation, get rich quick device. And when Wall Street starts legitimizing that, they're in it for the fees, not because they think, they're going to be making
Yeah.
money off of that, hell or high water. Don't worry about that. And I don't want people to think that just because Blackstone is offering it or something that legitimizes the asset. Sure, there's going to be some more, maybe some, legislation and regulation around that, but I don't see that being really, you're still going to have the same mom and pops going into it. You're going to have the
Yep.
same people, trying to build a career off of themselves, trying to build a legacy off of themselves by, getting into the crypto game, trading, and it's just when you start seeing the fast money, that sort of turns off the families. Does that make sense?
No, it makes sense. Absolutely.
Okay.
Well, how about industrial then? I know that's kind of the asset of choice in the real estate world. Talk to me about where you guys are there and what the future holds.
Yeah. We co-invested with a prominent family in Southern California before the pandemic in a Class A industrial development. And I didn't know what was going to happen, but during the pandemic, anyone who was around the industrial asset class or this, for example, were necessity workers, right?
Mhm.
Or essential workers that were needed.
Yeah.
For example, we have Carrier Air as our tenant, right? Everybody in Las Vegas needs an air conditioning. Everybody needs tools. Milwaukee Tool is there. So when we underwrote this, it was around a 7. Now it's clocking in much higher. But you have to keep in mind, Kevin, the whole reason why we went into this, and I had these conversations with some investors who actually learned the most expensive way they could, not to chase yield. The investors who came into this were already rich. They were looking for something to take care of a trust, right? They didn't want tenants poorer than they were. And the people who were chasing, the highest return or the highest IR that was on a pro forma that they could see, are the ones who lost $250,000 because they didn't know what they didn't know, and they just saw someone promising, a great investment. It's real estate. How can it go wrong? And a value-added opportunity in Cincinnati with a Class C to Class B. What happens now, right? There's all sorts of problems between the debt, between inflation and everything. All those costs are implicitly passed on to the landlord. And if your tenants can't afford rent, you have a problem. And then that's what we're starting to see right now. It's like inflation has actually driven the sub asset class of multifamily residential to people when they're moving from Class A. Now they're moving down to Class B. They're moving from Class B to Class C, and Class C to, Class D, or maybe a mobile home park or something, maybe a mobile home. I think, you're dealing with issues that people can never really understand. And that's really the due diligence of it. It's not really like looking at the numbers and looking and pretending you know what you're looking at on a spreadsheet.
That's right.
It's for us, it's like, okay, where's this market going to be going forward? Is it going to be able to absorb this? What happens if there's another shock to the system? And everybody's going to need something related to industrial. And let's face it, I hope this country will never have it again, but if any sort of lockdown, you still need things in storage. I mean, Amazon thrived off of this because everybody was buying last mile. You need those industrial facilities, and that's the whole point of it. People will still be buying, people will still be doing stuff, and that's really seems to us to be, a pretty good bet with that. New York office, Class A, that's sort of more of a speculation. That wasn't necessarily sort of like a core type of deal. But when you look at these opportunities, people always look at the returns. And I said to the guy, I said, look, there's a lot of good things that need to happen before you get a check off of this value added deal. And he didn't, he was like, oh, what do you know? He was a doctor. We're not going to, but just, where I'm going with this.
I mean, I think that's the difference of a broker OM and in reality, right?
Yeah. I know, but he's like,
all you got to, hey, Sal, all you got to do is lease up this 430,000 square feet. I mean, that's it.
Yeah. I mean, that's a whole other story. But I mean, when you're dealing with these, these people, to them, a sign of intelligence, and it's not, is reading like them finding the highest return they could, right? It's a sign that you take extreme risk. And they, a lot of these guys went in there, these families, middle class people, and they started going into these deals and they looked at the risk like a wine list, just over to the right and down to the bottom. Oh, that's the highest return. I'm going to choose this one that's offering me a 25% cash on cash return. And if you don't believe me, there's a proxy you can use called prosper.com. And I used to play around with that a little bit during the pandemic, and I still do. And you could tell, like, every time the NR, meaning not rated loans, they were too like risky to be, those will always be bought up first. With the other guys, with like the stable credits, the 8% or something, they'd be, they would be, you'd see their offerings and they wouldn't be as filled as fast as the ones with the higher rate, because everybody is in get rich quick mode today, especially the middle class.
Yeah. No, it's a very valid point. I mean, just in our world, I mean, we're not in the multifamily space, but just seeing how it all played out with the, you mentioned the multifamily syndicators, the folks that had not been through, any other cycles historically, right? It's just, it's easy money, debt's really cheap, buying, C-class properties, putting a few $100s or a few $1,000s into each unit, and ultimately, taking retail capital to do it. The retail investors really don't know what they're looking at. They don't understand, they're IRR driven. They still actually don't, most of them don't know how IRR is even derived, but they're IRR. They're IRR driven. They're looking at what is my highest return in that 3 to 5 year span that supposedly this investment is going to be held over. That's the one I'm picking, right? It doesn't matter if the credit risk associated with the tenant base was never taken into the equation, never taken into consideration. So speaking to like the industrial stuff you guys look for, it sounds like what your comparison to that of the A class stuff you guys do versus that of the the B and C class industrial, St. Louis versus, I don't know, pick the markets you guys love that you're in, right? I don't know, Salt Lake City, Southern Florida, right?
Yeah.
Whatever, right? Yeah, but it's credit. Milwaukee is a tenant base, or you named a couple other ones, right? But all high value credit tenants versus that of just mom and pop, mom and pop tenants that might pay, might not pay, right? Like not as much of a balance sheet to support, the just the value of the pro forma. So. It's
I
very
had this conversation with someone, when I was younger in my career, I talked to a pension fund manager for my first fund. And coming out of Goldman, everything was like, there's a certain way to put it together where other institutions will pay attention. But I had one pension fund manager say, Sal, my beneficiaries can't eat IRR. They only eat cash on cash returns. So anytime you see something from us, we put the IR towards the end, the cash on cash up top, so people can understand that. It's a method of communicating. And yeah, a lot of these people who get into this stuff, they don't understand it, nor do they take the time to really understand it. And it's not until as the Bible says, your heart is where your treasure is, that you start paying attention to what's really going on. That's, for most people, is when the real diligence starts. Is after I make the check, they're paying attention to it right now. And if some people took the time to really educate themselves, but not really educate, but network a little more, because you got to think about it, a lot of people who are in these retail investors are siloed by their profession, Kevin.
hmm
If you're a
yeah.
doctor, that's all and that there's a top surgeon who maybe makes $1 million a year, and he's telling you, oh, I got this great deal. Oh, I got this great crypto coin. I got, ICOs. I've seen it all. You can't really rely on that, right? I mean, if people who are not in the industry, on what we call the buy side part of the industry, private equity, you need to network with those people. And that means, getting out of your comfort zone and getting on a plane and going somewhere else to meet people, and wearing clothes. And a lot of people don't like to do that. Even Zoom, Zoom meetups too, anything. But anything where you can get totally enamored with, and also totally um, indoctrinated into seeing how the real world works in these things, you'll open your mind. And we invited a lot of our families. We had a new family that came out, and he didn't understand anything. He has a lot of money with us, Kevin.
Hmm.
And he had no idea how any of this stuff was working. He's like, I understand, my brother-in-law, he's telling me I should invest in this Marplay family, but you're telling me industrial. And I'm like, I mean, it depends. Do you want to go to bed at night having tenants richer than you? What's the story? Like, what is, they were already at rent escalations that they're going to pay because it was already negotiated into the 10-year lease. Where do you want to be? And I think that's the question a lot of people don't ask themselves, is that, they'll look at something that's stabilized as being less desirable an asset when it really isn't.
That's right.
Due to the fact that, they don't know any better, and they're just looking at it pure from the numbers, and, they're
hmm
trying to do that. I was also I'm kind of a firebrand sometimes at these conferences, because I've been going to them one time. And this one guy, I remember, was outside during a breakout session. There was probably about 7 guys over like a high top table where everybody was enjoying drinks and peanuts. And the guy's like, well, I gotta underwrite the credit of my tenants. I'm like, what do you mean? Your tenants have no credit. You're in multifamily. And everybody just laughed. Like, no, I don't care if they have an 800 FICO. It doesn't matter. They don't have a job tomorrow.
Yeah.
That doesn't, that is a very, very practical example of what that looks like. And people don't understand that. That's, it's what it is. It really is what it is.
Yep. No, valuable point. So I want to kind of round this out, Sal. And we mentioned in the very beginning of the show, like we're not necessarily in the real estate or in business acquisitions. I mean, we're in the relationship business. I mean, our
Yeah.
entire your business, my business, all built around relationships. Without the relationships, it doesn't exist. And so
Mhm.
maybe speak a little bit more to just just what you guys have done, what you've done, and as far as like this establishing your networks and building these relationships,
Yeah.
again going deeper than wider, and ultimately
Yeah.
again I take you as someone that's really building a company that will stand the test of time. I mean, that's your primary objective there, and a lot of that revolves
Yeah.
around these relationships. So maybe speak to that if you would.
Yeah. I think people, when they're coming into this and they're learning to syndicate, the pandemic did this, and it turned everything more into transactional than it was, right? So
Mhm.
everybody's sneaking into your DM, selling you crypto. Why don't you invest in, all of this stuff? And it made it very, very transactional. Whereas people today, I think, they want that they want that serotonin exchange. They want that interactivity. And one of the things that I do, and I spent a disproportionate amount of my time doing this, and it's something I learned at Goldman Sachs. It's like being a coverage banker. You're always on top of your clients. I'm always on top of my investors, new ones, old ones. I had one call me from New York City today on FaceTime, just to, shoot the breeze, because he knew I'm from there. And he's like, hey, I'm passing by your old office or something. That's great. People want those relationships. If you don't have those relationships with your investors, what do you really expect? And I think people today, they need to spend a disproportionate amount of time doing that. We do it with email. I'm always posting photos from my week when I travel to conferences. Since living in Miami, I've started my own network. It's called the 305 Intelligentsia. And we have families and investors who are real people I've known and gotten to know, and we all meet up for coffee or drinks at some point. And It really is good. It's a community building around it. It's not just the relationships, but it's building the community around it. That's why I send, 2 emails a week, maybe three. That's why I post a lot on LinkedIn, is to see,
Hmm.
when you're on top of people, you have their attention. And the most valuable thing today, even though we talked about the Strait of Hormuz and oil, really isn't oil. I mean, that affects the country pragmatically. But if you were to look at the most valuable asset today, it's attention. And that's
Hmm.
something I've learned, where people who have attention are the ones who are the wealth creators, especially in
Yeah.
media. People who have a lot of followers. I met an author, and he took photos with me. His name's Chris Ye, of a book that it's a Silicon Valley, Bible. It's called Blitzscaling, and he taught a course at Silicon Valley and put it together with someone else. And I can't believe he's holding a copy of my book. It's funny pictures and everything, but he's building a community. We talked about this. It's a community. Think about it.
Hmm.
Like, the content creators, whatever, wherever you look at, those people today, the people who own media and attention, are the ones who are building the most wealth.
Yeah. No, I love everything about it. So Sal, for those that want to learn more about you and what you have
Yeah,
going on and get in contact, what's the best way? I know you mentioned LinkedIn. We'll make sure to put your LinkedIn
yeah.
handle in the show notes, but any other place to track you down?
They might want to track me down by I'm going to give away a free copy of one of my books, Investing Legacy. If they go to investinglegacy.com, they can get a copy of that, or they can email me if they want to, sal@brahminpartners.com, BRAHMIN partners.com. That means high priesthood in East Indian culture, but it also means high priesthood in New England Bostonian culture. And that's a sort of like a nomenclative nod to some of our families and some of our founders, and my co-partner, who is from there originally. And as a New Yorker, I'm fine with that. It's better than calling it Yankee Partners,
Yeah.
right?
Hey.
So, you know,
Oh,
yeah,
that's funny.
it is. But I think, if you look at it, you read it, we're building a culture, and that culture is important. People are attracted to a culture. The opposite of that is toxicity in the workplace. You hate your boss; they're always beating you down. Always, you're afraid you're going to be fired. That's toxic. But we build it so that we help each other, and it goes beyond just asking for dollars. I've written. I like to write. I've helped people, write their college entry essays, and some of our investors. We've done a lot. We brought some of our CEOs to families. We brought some family offices to some conferences and everything. So, we like to tell them where we're going and how we're working together, and it works out really well that way.
Awesome. Well, I appreciate it, my friend. I really appreciate you coming on again. It's been a while, but always good catching up with you. And it sounds like you got great things happening. So we'll look forward to following your journey and bringing you back on maybe in the next year and a half, and to see how things are going. But
I
guys,
love
with
it,
that,
Kevin.
yeah, no, and guys, I'll put all that stuff that Sal mentioned. The book, the link to the book, LinkedIn, and we'll dig up any of your other social handles that you spend time on. It sounds like you spend most of your time on LinkedIn, but either way, we'll get all that in the show notes along with your company website. And I know you mentioned you put out a lot of emails. You've got an
Yeah.
email list that folks can join to just dive a
Yeah.
little deeper into the value that you're providing.
BrahminPartners.com. Yeah,
Yeah, fantastic.
BrahminPartners.com, or just send me an email. Yeah, that's fine, and I'll respond to it. Kevin, this
Awesome.
has been great. Thank you for the privilege. I really do appreciate it.
Absolutely. Thank you, Sal. Guys, thank you. That's all we had for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care.